Here's a look at where markets ended the week with third quarter earnings season underway and Treasury yields once again hitting new multi-year highs. We also saw oil prices climb back above $90 a barrel this week, and Federal Reserve Chairman Jay Powell signaled that the pause on interest rate moves will likely continue amid high inflation. Joining me right now to talk about all of that is Janney Montgomery Scott's Chief Investment Strategist, Mark Luschini. Mark, great to see you. Thanks very much for being here.
Thank you, Maria. Same here.
So, what do you think is most important for stock investors going into year end? You've got yields on the 10-year, the 30-year, now at 16-year highs. Has that been a factor?
Oh, it certainly has, Maria. I mean, typically this is a seasonably favorable period for stocks. Obviously, we are always geared up for a year-end rally here that typically manifests about mid-October through the end of December. But obviously, we're waiting for it to develop because obviously investors are concerned about not only rates, but what you had mentioned as well, which is energy prices, which could feed through to inflation and obviously keep the Federal Reserve vigilant on their attempt to thwart it. But in the meantime, you know, when you're approaching 5% on the 10-year, when you think about the equity risk premium, which is basically taking the inverse of the price to earnings ratio of the S&P 500 and subtracting from that the yield on the 10-year Treasury bond as a proximate alternative to stocks coming in the form of yields that can be earned in the bond market, that equity risk premium today is about 1% or even maybe a little bit less. So typically it's 3.5% to 4%, which is to suggest that actually, you know, equities don't have a lot of, if you will, risk premium built into them at this valuation, suggesting that on balance, bonds actually look a little bit more attractive to investors that can allocate across multi-asset classes. And so I think that is something that investors are grappling with as they think about how to allocate risk-based capital.
Yes, exactly. I mean, now you're getting some real competition to investing in the stock market. If you could invest in fixed income and get 5%, maybe that's why we've seen the volatility. Does that continue into year end, do you think?
Well, I do, because what we're seeing is actually better than expected economic growth. I mean, we're going to get a third quarter GDP number here shortly, but if the Atlanta Federal Reserve is at least giving some directional by order of altitude indication of where they may come out, is probably going to be a 3 to 4% GDP growth rate in the third quarter. Well, probably not likely to be sustained through the end of the year ultimately is indicative of the fact that obviously with economic growth being better than expected, at least so far, even as inflation is beginning to dissipate somewhat, is going to keep the Federal Reserve vigilant on, again, maintaining higher for longer, if not even the prospects of an additional rate hike before the end of the year alive and well. And obviously that continues to keep equity investors on their heels.
Mark, let's talk about the price of oil, because this is also an issue here. When you have $90 or $90 plus oil, that cuts into consumers' ability to spend. Is that going to slow down the economy?
Well, I mean, today the level of energy intensity in the economy certainly isn't anything like it was back in the early 1980s. But having said that, it's an advertisement to consumers every time they drive past a gas station and see oil prices in 2 feet high advertisements posted on the corner of the gas station. And so it serves as a reminder to consumers that more is being siphoned, if you will, out of their spending behavior into their gas tank, as opposed to other things, particularly travel, leisure, and entertainment, that have been benefiting from the post-pandemic splurge that investors, or that as consumers, have undertaken. And so yes, it can have a big influence. And we're only really starting to see any kind of geopolitical risk premium built into energy prices at this level. If obviously we get 1 or 2 more turns away from what is taking place in the Middle East today, metastasizing into something that involves more directly or more definitive proxy with Iran, and obviously we undertake some kind of weaponization of oil prices, obviously they could spike considerably higher from where they are today, which would really be a problem for economic activity, not only here in the United States, but elsewhere around the world.
Okay, we will leave it there. Mark, it's good to catch up. Thanks very much.